Welcome to Alpha Recap. Thanks for joining us. We're coming to you after the close with a quick rundown of the big themes from today. As always, if you have questions, you can reach us at stockalpha.ai.
Lovely to be here. Markets closed with a pretty clear split today. Winners tied to AI and networking, and a louder thread about liquidity and policy risk. Lots to unpack.
Right, let's jump in. Big names and tiny ones both made headlines. First up, Lightwave Logic. Small company, big optics news. They spiked in after hours by about 7.5% after announcing a development deal with Tower Semiconductor to integrate Lightwave's electro-optic polymer modulator into Tower's PH18 silicon photonics design kit.
Yeah, that was neat. Basically, they moved a materials-level innovation toward a foundry workflow, which, if it works, makes it easier for system makers to actually use the tech. So optionality turned a little more tangible.
Exactly. To put it simply, AI systems are eating bandwidth, and optical interconnects are one answer to the data movement problem. If you reduce power and latency between racks, you win efficiency. But small firm high beta, the headline helps, but it doesn't guarantee volume or margin gains.
Enthusiasm at that size is headline sensitive. One integration milestone is not a revenue stream yet. Still, promising.
Speaking of promise, Cisco finished the day up after a classic beat and raise quarter. Management pointed explicitly to networking strength and AI-related demand driving upgrades.
For a mature, large equipment vendor, beat and raise is a real signal. It suggests capital spending on networking, spine leaf upgrades, AI cluster interconnects is real and not just hype. That matters for both growth and dividend narratives.
Yeah, for conservative growth allocations, this reduces execution risk. And for income investors, steady cash flows keep the dividend story intact. So Cisco gave a bit of a safe way to play the AI infrastructure theme.
Big picture. Two ways to play AI infrastructure today. The large, cash-generative names like Cisco, or tiny optionality plays like Lightwave. Different risk profiles, different expected paths.
Totally. But it wasn't all tech cheerleading. The private credit market flashed a pretty strong liquidity warning today when a Morgan Stanley fund capped withdrawals. And that matters because the private credit universe is roughly $3 trillion.
Right. And the mechanics are worth spelling out. These funds lend to middle market and leveraged borrowers where there's no deep secondary market. When redemption pressure shows up, managers can impose gates to avoid forced fire sales of illiquid loans.
So gates protect the fund in the short term, but they increase redemption uncertainty for investors. Which raises the question, are these preemptive healthy steps or early warning signs of deteriorating loan quality? Opinions were split today.
Some see it as sensible liquidity management. Others see it as a harbinger, a signal that marks and valuation transparency have gotten messy. Either way, for yield-seeking investors, it complicates things.
And there was another policy twist. Goldman Sachs pushed back its forecast for Bank of England rate cuts, citing energy-driven upside to inflation. That tightened the window for UK rate relief.
Which has practical knock-ons. If energy keeps inflation sticky, retail and mortgage names and UK gilts face constrained upside until cuts show up. Currency and carry trades will feel it too.
So between private credit gating and a delayed Bank of England cut, the tape had this cautionary macro overlay. The day was a study in contrasts. Clear stock-level AI winners, but structural liquidity and policy uncertainty overall.
And then some micro news. Oracle increased restructuring costs by $500 million. Citi came out saying they were reassured by the results and guidance, but not everyone will nod along and call that a one-time headline.
That debate is classic. Prudent housekeeping that clears the runway, or operational strain that needs a valuation reset. Time and execution will tell.
We also saw dispersion among smaller names. Evertech was down about 15% over 6 months to $28.41, and Albany was down about 3.5% to $56.03. So while AI/networking names showed momentum, a lot of mid and small caps lag.
And a quick microstructure note. DXST jumped up about 11% to 44 cents on heavy volume. 124.75 million shares. Low-price stocks can spike like that and attract speculative flows. High variance, so be careful.
Big move.
Not what anyone expected.
Yeah, that tracks.
Let's break down implications by investor type. Quick and practical.
For long-term growth investors, keep allocating to AI infrastructure, but be selective. Cisco is a lower-risk way to capture that demand. Small innovators like Lightwave have asymmetric upside, but require high conviction.
Right. Focus diligence on clear pathways to revenue. Foundry agreements, PDK integrations, OEM qualification. Those are the milestones that turn optionality into cash.
Income and conservative holders should check liquidity buffers. Private credit frictions mean you shouldn't overstay in illiquid yield if you might need cash. Large caps delivering cash flow remain useful anchors.
Fixed income managers. Goldman's BOE delay raises short-end rate risk in the UK. Plan for a higher for longer scenario until energy eases. And tactical traders. Small caps and micro caps had the most headlines. Trade size accordingly and use stops.
Private asset allocators. This was a wake-up call. Re-examine gating language, mark practices, and stress test your NAVs under liquidation scenarios. If gating risk is unacceptable, consider trimming illiquid allocations.
Okay, quick strategic watch list. What to track next?
Number 1. For AI infrastructure, differentiate optionality from execution. Look for volume production agreements, PDK rollouts, and foundry integration milestones.
Number 2. Reassess your liquidity footprint. If you've got private credit, model worst-case redemption timelines and align to your own cash needs.
Number 3. Watch energy and Bank of England signals. A sustained energy shock keeps cuts off the table. A quick energy disinflation flips that dynamic fast.
Number 4. Stay tactical on dispersion. With clear winners and losers, stock selection beats blind beta in this environment.
And finally, watch for dominoes in credit markets. Private credit gating is a leading indicator. If mark-to-market erosion broadens, spillovers to high yield and bank funding conditions could follow.
Let's wrap with 3 clear takeaways. 1. AI and networking remain the stock-level growth story, with names like Cisco offering a safer route and tiny firms offering optional upside.
2. Liquidity risks outside public markets are elevated. That private credit gating wasn't trivial. It raises real questions about redemption risk and valuation transparency.
3. Policy matters. A delayed Bank of England cut tied to energy means rate-sensitive assets could have a tougher near-term path. Monitor energy and inflation data closely.
So that was the day. A market of contrasts. Bullish micro-catalysts on the tech side, but a cautionary macro overlay on liquidity and policy.
If you want a deeper dive or have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. We'll be back after the next close with more. Take care.